Welcome back. In this video, we're going to look at the comprehensive example that's covered on pages 124 through 126 in your textbook. If you recall from Chapter 2, we had this company called HiTech Communications, and they provide advertising services and other things. Well, we're back with HiTech again, and we're going to look at 7 different adjustments that need to be made to HiTech's books before the adjusted trial balance can be determined. So let's start with adjustment number 1. During March, HiTech had performed $1,500 of advertising services, but it had not yet billed the customer. So we need to record the revenue adjustment that would occur at March 31st. Well, had HiTech earned the revenue? According to this example, yes. They performed the advertising services, so the revenue has been earned. That means even though the company has not actually received payment for the revenue, it does need to record the revenue. That would mean an increase to retained earnings, because when we increase revenues, we increase net income, which increases retained earnings. And we'd also have an accounts receivable entry, because the customer would need to pay HiTech. So let's look at how that entry would actually happen. We'd have the date March 31st. The adjustment would cause a debit of $1,500, which is an increase to accounts receivable, and a credit entry of $1,500 to service revenue, again, because that's how we record a revenue. Let's look at the next one. HiTech had apparently signed a note payable on March 2nd, and it required it to pay interest at 8% annually. The cash interest payment will actually occur, though, at a later date. So we have to, as of March 31st, record what was the interest expense. Well, first we have to figure out if the note payable is for $3,000 and it's 8% annual interest, what is the monthly amount? Because as of the end of March, there would only be 1 month worth of interest that would actually have been expensed. Well, we can take the number 3,000, multiply it by 0.08, which is how we would account for 8%. If you recall, 8% is 8/100ths. So 0.08 times 3,000 gets us $240. That's the amount of interest HiTech would owe for a year, but we're only talking about 1 month worth, so let's take the $240, let's divide by 12, and we get $20. So $20 is the amount of interest that HiTech actually owes for the month of March. Well, that's going to be an expense of $20, which is a decrease of $20 of retained earnings. And it's also, since they're not actually going to pay the interest at the end of March, it's just going to be owed. We know that there's going to be a $20 liability that has to be added also. The way that we would actually complete this journal entry is to say that as of March 31st, HiTech had expensed $20 in interest, and an expense would be a debit entry of $20, and would also have an interest payable amount of $20, which we record as a credit because it is a liability. Let's look at number 3. HiTech had paid weekly salaries on March 26th. Salaries are $360 a day. They're not going to pay weekly salaries again until April 2nd. However, when we hit the end of the month, which is March 31st, there will be 3 days of work at $360 a day that employees would have actually earned. Now, if the employees have actually earned the money, they've done the work, March 29, March 30, and March 31, then surely HiTech has an expense, right? Those were expenses that were incurred. So we're talking about an accrued expense here. Unrecorded expense that was actually incurred during the period. Well, let's figure out how much it is. It's 3 days worth of salaries at $360 a day. That comes out to $1,080. So there's $1,080 of expense, which is a decrease to retained earnings, and they didn't pay it yet, right? It's an expense that's been incurred, but it hasn't been paid in cash yet, which means there's an increase in a liability to the tune of $1,080. Let's look at the journal entry. On March 31st, HiTech would have to do an adjusting entry that gives a debit of $1,080 to salaries expense and a credit to salaries payable. Now remember, it's a debit to salaries expense because it's the increase in an expense account, and expense accounts have a normal debit entry. And salaries payable is an increase in a liability, and liability accounts have a normal credit balance. Let's look at the next one. HiTech's trial balance shows that a customer paid $9,000 in advance for services to be performed at a later date. This was a while back. The customer had paid $9,000 in advance. As of the end of March, HiTech earned $3,300 of that revenue. So, had HiTech earned any revenue? Yeah, which means at some point in the past, HiTech had booked a deferred revenue, an unearned revenue amount of $9,000, but now not all of that revenue is unearned. So we have to remember, unearned revenue is a liability. We've got to decrease that liability account by the $3,300 that was actually earned, and we have to increase retained earnings by the amount of $3,300. So let's look at that journal entry. On March 31st, HiTech would book an adjustment entry that gives a debit to unearned service revenue, meaning I'm decreasing that liability account, and a credit entry of $3,300 because I am increasing an earned service revenue account. In addition, on the trial balance, which is actually what we've been working on in Chapter 2, there was a balance of $6,500 in the supplies account. But on March 31st, someone did an inventory of the supplies account, and what they discovered was that the total supplies on hand was $1,200. Well, what does that mean? Well, the $6,500 in the supplies account is like having a prepaid account. There had been a deferred expense sitting in there. Well, now we've used some of it. In fact, all that's left is $1,200 worth of supplies. That means if we take $6,500 minus $1,200, we find that there would have been $5,300 of supplies used. Well, supplies used is a supplies expense. So we decreased retained earnings by $5,300 of supplies expense. And the supplies account, that prepaid supplies account, which is an asset account, decreased by $5,300, so we decreased an asset account. Let's look at the final journal entry. As of March 31st, we would have entered a debit of $5,300 to supplies expense because we'd have an increase in an expense account, which is always a normal debit balance. And that asset account that we called supplies would have been decreased by $5,300, which is a credit entry. The next adjustment deals with the prepaid insurance account. Back in Chapter 2, we had actually booked a prepaid insurance amount that left the trial balance showing a balance of $1,200. It was related to a 6-month policy that was purchased at the beginning of March. Now time has passed. Remember, it's a 6-month policy, and that prepaid insurance is now partially expired. If it was a 6-month policy for $1,200, that's $200 a month. So for the 1 month of March, the prepaid insurance had been depleted by $200. And if it was insurance that was actually used, then we would call it insurance expense. So the journal entry as of March 31st would have booked a $200 debit to insurance expense because it's an increase in an expense, and we would have decreased the prepaid insurance asset account with a credit of $200. There would have been a $200 decrease in retained earnings and a $200 decrease in assets. Lastly, we noticed that on the trial balance there was $4,500 of equipment that was purchased. That equipment is used to generate revenue, so a portion of the usage of the equipment must be allocated to expense. And if you recall, that expense, which deals with the loss of value of a long-term asset, is called depreciation. And that depreciation expense for this particular equipment is $125 a month. So we would be making a depreciation adjustment entry. As of March 31st, there would be a depreciation expense of $125. And notice it's an expense, so it's got to be a debit entry. And there would be a credit entry of $125 to that contra asset account that we call accumulated depreciation. Overall, there would have been an expense of $125, which would decrease retained earnings, and a decrease in long-term asset value, which would have been a decrease in $125 to assets. In the next video, we'll be covering how we finally can close the accounts.